Okay, well, we got a lot of information to get through here today. I got about 40 minutes and 20, so we're going to go really fast. I got to say, it is great to actually get up here and speak in front of people. I've been doing tons of these presentations to Zoom where you're looking at a tiny camera, and it's kind of anticlimactic. You don't get the audience response. You don't get the interaction that we usually get. I don't get my hecklers, which I usually approve of, right? But the pluses of doing the Zoom, though, is you can do it in your underwear, right? So, I mean, I really do love that. He knows, right? He knows, right? Yeah, exactly. So, no, but I do really enjoy getting out and doing these live now, so it's awesome. So, for those of you that don't know KeyStone, I'm just going to tell you quickly a little bit about us. We are a truly independent Canadian financial stock advisory. So we provide buy, sell, and hold advice through individual reports to our clients. We are not paid by the companies we recommend. We are paid by our clients, individual investors such as yourselves, or institutional investors who pay us to find the best companies out there. Essentially, that's what we do. We go through our analysts at KeyStone about all 3,500 companies in Canada twice a year. We go through about 4,000 in the US. We use a GARP, or growth at a reasonable price approach, and we want to find in a year maybe 5 to 10 individual stocks that we can add to our clients' portfolio. So that's how our methodology works. But why the hell should you even listen to a guy like me is what you should really be saying, right? Why the hell do you even want to listen to me? Well, I would say that I've been doing this for around 23 years, and I think I have just a little bit of knowledge I might impart on you, but again, who cares about that? I think proof is in the results. So last time we did an in-person event here, Jay held an event, I think it was 2019 or 2020. I did a speech like this and I recommended 5 stocks. So let's just see how those 5 companies did. And you can see there, that is the companies. Expel obviously is a tremendous winner. This is a company we actually recommended originally at $1.40. It's been a game changer for our clients' portfolios, hugely profitable business. Dynacorp, I'm going to talk about them today. Sangoma, Viamed, Questar is the only laggard, but opposed to the index, the Toronto Stock Exchange is up 34% over that period. These 5 companies are up 180. So that tells me that we've hopefully done our job there. So before I get to the picks and shovels approach to play the current commodity boom, I'm going to look at one question that you should be asking yourself, and often when you attend an event like this, you're most often looking to take some risk in your portfolio to find 1 or 2 great stocks that can help change your portfolio. And it can happen. Often, however, and we see the average investor do it the wrong way when they're trying to find these companies. So let's take a quick look at this concept before I get to the stocks I'm going to recommend today. Now, this concept, is it true? Can 2 or 3 investments be kind of life-changing for your portfolio? I will say yes, it is true. We've had this happen for clients over the last 2 decades. Today, I'll show you why this is not hyperbole. Essentially, you won't hear this from most financial advisors, and why the traditional way that you construct your portfolio is preventing you from accumulating great wealth through great individual stocks. I'm going to show you how you can capitalize, kind of change the structure of your portfolio very simply to capitalize on these companies. Now, I'm going to give you 3 examples of stocks that have changed portfolios for our clients. Now, when I say truly great stocks, what am I essentially referring to? That would be a textbook definition for me is great, profitable businesses that consistently compound earnings over time, growing cash flow on a per share basis and driving their stock prices higher. I like to give real world examples. These are examples from our research. I put these percentages up there because they make me look smart, but that's not really what we're here for today. We're here to your question should be, find me the next Boyd, the next Expel, the next water furnace. So that's what we're going to discuss today. 2 of your questions I would say after seeing that is, how do I find these companies? And how do you construct a portfolio to be able to capitalize on these type of companies? Well, I'm going to show you what these great businesses have in common. I'm going to give you 10 key factors of the profile for these type of stocks that we like to put in our client portfolios. Now, it's not exhaustive list, but if you have 7, 8, or 9 of these that are checked off in the companies you put in your portfolio, the better you'll do over the long term. Number 1 would be a strong balance sheet. Foundation of a business, access to cash or cash in the bank allows a company to grow and survive during downturns. We're seeing a downturn now. What we're buying often is cash-rich businesses that can survive, buy other businesses, and come out and thrive on the other side. You want positive cash flow. Without cash flow, businesses haven't proved they're economically viable. Investing in cash flow negative businesses is highly speculative. So you want an attractive long-term growth path for the business. Ideally looking 2 to 5 years out. We'd love to look 10 years out on businesses, but it's hard to forecast beyond 2 to 5 years. It's often hard to forecast beyond a year at times. But we look for good growth paths in the long term for the businesses we invest in. Reasonable valuation. So valuations are a tricky subject. What I can tell you is you're typically not looking for the cheapest stock out there. Most really cheap stocks are cheap for a reason. On the other hand, regardless of how great the growth appears, you can't just pay anything for a stock. I think Shopify is a pretty great business, but it was trading at ridiculous valuations. That stock, which used to have the highest market cap in Canada, has lost 80% of its value since November. Why? Because it was overpriced. Now, our clients come to us today, it must be cheap, losing 80% of its value. It trades at 143 times next year's earnings. It's still expensive, so there could be still more pain in a name like that. Valuations matter. It matters, even if it's a good business, it matters what price you buy it at. So we like dividends and dividend growth stocks. We can't get that in all of the businesses. Some are really high growth and they're plowing the money back into the business, but dividend growth stocks outperform the market over the long term. What else do we like? Solid management team with significant skin in the game, meaning teams who own shares in the businesses. You can't always get that, but if you have that aligned with you, they're pulling on the same rope, they're typically going to do things that are favorable for you as a shareholder. Now, businesses that we can understand, if we can't, when we're looking through 3,500 companies and doing it for 20 years, if we can't understand what the hell they're doing or what they're talking about, we move to another company. Now, operations in relatively safe jurisdictions. Of course, the 3 companies I'm going to talk about today are not in the safest jurisdictions. That means you have to have a 20-25 stock portfolio. These are 3. You can have some risk in your portfolio, just not all of the companies being in risk. Now, positive industry sentiment or niche. I would put this down, or a niche outlook, essentially. I would put this down to, you can find cheap companies. You can find a cheap coal company, for example. When we do our screeners, we look through all the companies. You can find some trading at 1.5 times, 2 times cash flow. But they're classic value traps for us. If nobody wants to buy or invest in coal companies, they're value traps, classic value traps. So you have to have relatively good sentiment behind the industry that you're looking at. And a strong track record. We judge this over time. We meet with management teams. They issue guidance or have goals for the company every quarter. The more they hit those targets over time, the better the track record. The more they miss, obviously the opposite is true. So the second point here that I would talk about is how do you construct a portfolio to capitalize on Expel or Boyd or Water Furnace in your portfolio? Well, first, do not take unnecessary risk. Many investors operate under the misconception that they need to buy speculative, unprofitable moonshots in order to achieve the type of returns they're looking for. The 3 companies that we put up there that we display are the exact opposite of that. The thing that they have in common is, and they have actually produced the blue sky returns that you're looking for, is they are all great businesses that continually generate cash and make more money over time. It doesn't have to be more complicated than that. You don't have to buy the sexiest story on the street. You just have to buy cash flowing businesses that create more money over time. And the stock returns over the long term, maybe not in the short term, but the long term, they'll take care of themselves. So if you want to truly benefit from owning one of these game-changing stocks, you cannot do it by building what we said, the traditional way that you build a portfolio. Now, it sounds controversial. It's really not. It's simple. We've been talking about this for decades. What does the traditional portfolio model look like? Well, you typically go to your bank, you plunk down some money and your information, and they spit out 5 or 10 mutual funds that you're going to own. Each of those mutual funds, essentially, this is what we call a broken model, but each of those essentially has 50 to 150 stocks in them, and you're owning 10 to 15. Well, you bought the market 2 to 3 to 4 times over at that point. All you've accomplished is you got a portfolio that mirrors the market in terms of returns, but underperforms due to the ridiculous fees you are charged. So you end up with a complex portfolio engineered to continually underperform the market. With this type of strategy, you have no chance of beating the market over the long term, and that's why you attend a conference like this, to find investment ideas that help you beat the market. So I will tell you quickly before I get to those companies what we think you should do. We think the sweet spot is to buy 15 to 25 companies. Build that portfolio over a 12 to 24 month period. That reduces the risk to short-term market corrections. So if you started your portfolio a year ago, you're 6 months in and there's a significant correction, you've got 60% of your portfolio will be bought now at cheaper prices. There's no perfect way to enter the market, but this is a great strategy. Again, it provides flexibility to add to new positions as new opportunities develop. Right now, our analysts are doing a survey on about 400 US technology companies, industry that's been hit the hardest during this period. We think we're gonna find some babies that get thrown out with the bathwater. That's where we're looking right now, so you're gonna have some opportunities. So what's the process? You become a client tomorrow, for example, or you wanna start your own portfolio tomorrow. You wanna go out there, start 3 to 5 initial positions, so purchasing in individual stocks. Then you're going to move every quarter, so every 3 to 4 months, adding 2 to 3 new stocks. You can also layer into positions. You do not have to buy a full position. If you had $100,000 and you're buying 10 stocks, 10,000 in each, you don't have to buy the full 10,000. You can buy a $5,000 position to start, half position. So, okay, hopefully that makes sense. That is our process. Let's look at the picks and shovels approach. Essentially, this idea is not exclusive to the mining industry. We have used it to play like the EV segment or the AI or crypto or fiber optics. But essentially, the strategy is named after tools used to mine for gold in the California gold rush back in the 1800s, 1840 to 1850. Prospectors essentially needed to buy picks and shovels to be able to mine gold. Now, while there was no guarantee that a prospector would find gold, the companies that sold the picks and shovels were very profitable and most often the best investments. So let's look at some of those companies. Today we're going to look at a gold mill, so a company that processes, a gold driller, and then we'll look at a renewable energy producer. The first company I'm going to talk about is Dynacorp, DNG on the TSX. Trades around 309, pays a good solid yield. That dividend was increased twice over the last year. It will be increased likely again this year. I mean, I can't guarantee it, but the cash flow is there. So it's a true small cap, $120 million market cap. What does the company do? It's very important. It's not just a symbol. We're buying a business when you buy this. So they operate a mill, not a mine. They produce gold by processing ore purchased from small-scale miners in Peru. Now, their profitability really depends on 2 factors. There's a couple factors as well, but essentially the margin between the price of ore purchased and the market price of gold, the higher the margin, the better. Throughput, so the more ore the company processes, the more ore that's brought to them, the better. The other factor would be in a rising gold price environment, it incentivizes more small-scale miners to bring them ore, and they make more money. We're seeing that happen right now, and we'll show you exactly what we're talking about. Now, this is a company that has 11 consecutive years of profitability, even during the pandemic. Very profitable business. That is basically unheard of in the gold industry. It's a very volatile industry, but you've got 11 consecutive years. Now, they just came out with their Q1, so good lift up in terms of revenues there, 50 million. Now, net income was up 142%. Tremendous jump there. 16 cents per share Canadian, up from 6 in the same period last year. Tremendous growth. Again, I point out well above average geopolitical risk because they're operating in Peru, but they are starting to diversify, which is part of the long-term story with this. We've owned the company since about $1.60. It's $3 now. We think it's actually cheaper now at $3 on a cash flow basis than when we originally invested in it. So we continue to like it. Here's the investment thesis. It's cash rich. and ready to essentially grow and expand. 27.5 million US cash in the bank. So it trades at $3 roughly. 85 cents of that is just cash in the bank. So we do where do we see the growth going forward? Well, they have one existing mill, a modern mill in Peru in the south. They could move to the north. The existing mill is going to be upgraded again. They've upgraded several times, so it'll have organic growth from that mill. They'll do that all from cash flow. There's 3 new mills planned over the next 3 to 5 years. So you have growth right now and growth going forward, all funded by cash flow, which is very important, so you're not diluted as a shareholder. Looking at the north in Peru, they're in the south now, sorry. Latin American countries, another that they're looking at right now, and West Africa. They have a joint venture in Senegal, but outside of Senegal, we're looking for another over the next 3 to 5 years. So organic growth, they target 10 to 15%. Well, last year they did 98%. So, you know, I like companies that underpromise and overdeliver. I would say this year they'll probably do 25% in that range, and that doesn't include new production or if they bring on new mills. So PE is, it's cheap. The market average PE right now is 18, 19. It's 6.3. Take the cash out of the equation, 4.6. Price to FFO is 5.5. Low multiples. Again, some part of it because of the geopolitical risk, but they're starting to diversify, which is excellent. And we think they have a long-term growth path ahead of them. So our fair value, 10 times, we're just doing a 10 times multiple, adding the cash back, 485. So trading at $3 in that range, that's a nice lift from here. You'll probably see a dividend increase from that point as well over the course of this year. The next kind of picks and shovels company, this is really like your driller, $2.35. It pays a dividend. They just instituted over the last year, upped it to start this year as well. $100 million market cap, so a small cap. What do? They're essentially a contract mineral drilling services company specializing in drilling for gold in West Africa. The majority of revenue, Ghana. They've moved into Egypt and Peru, so there's diversification. They signed their 3 biggest contracts in the history of the company just to start this year. It hasn't factored into the numbers. It'll factor in going forward. In terms of the numbers, last quarter, good solid growth there. Net income is good. We should see most of the growth in the second half of this year. But again, these are good numbers. Solid balance sheet, net cash position. Again, has cash, doesn't have to go to the market to grow. So, investment thesis, there's strong demand. There's a ton of money that was raised from juniors and seniors as the gold prices increased. This is a company that is going to benefit and has continued to benefit from that going forward. Fair value, we'd say it's currently trading at 2.2 times EV to EBITDA. That's a low multiple. You look at its peer group at 4.1. The biggest in the sector, Major Drilling at 6.5. Geodrill has far better margins than Major Drilling, is a better operator. They've traded around 3.3 times historically. So fair value at 3.75. We think you should get a slight premium, but still well below the industry. That would be 350, so it's trading 230 now. It's quite a lift from here. The end game is this company to be bought out at some point. We think 425 to 450 would be where the company was bought out. We just met with management in Vegas. We've known them for years, good operators. The last company is Polaris Infrastructure. Now, I wish I was here a couple weeks ago to talk about this company. I think it was trading at $16. It's moved up to just under 19. But we like the business. It's a good, solid business. It trades at a great yield, 4.25%. Market cap, still a small cap, $373 million. But Polaris is not just a symbol. It's not just PIF on the TSX. It is a renewable power producer. Latin America, they have primarily been operating a 72 megawatt geothermal plant in Nicaragua. Now, the real growth here is some acquisitions they made out of cash at the start of this year. So we look at them, they announced these significant acquisitions. We'll look quickly at that. The investment thesis here, 3 acquisitions year to date, which would diversify Polaris outside of Nicaragua. This is tremendous, from going from 2 countries they're in, Nicaragua and Peru, to 5. That is our investment thesis. They're expected to be funded with cash on hand, so they're not going out there and diluting investing our current shareholders. They also have growth from their existing facility. They're bringing on a binary unit, and that'll bring growth. So their fair value, $23.70. So in that range, it's about a 20% upside from here. Pays you that good solid dividend. If they get taken out, it's going to be a premium to that. I'm going to leave you with this right now, food for thought right at the end. Hopefully you can figure that one out, because I don't think he can. And we're good. Thank you very much.